It's 8:30 p.m. on the east coast of the United States, and so I guess there'll be a whole lot of our normal Danielcode supporters who'll be sitting down to dinner with their families, and I hope they enjoy that dinner. And for those of you who are here today, our numbers are pretty much depleted, which I guess we understand. Thank you for being with us today. It's good morning to those of you in the Sunshine State of Queensland. It's good afternoon to the rest of Australia, and a bit later still to our friends across the ditch in New Zealand. So wonderful to have you with us, folks. Peter Max with us, who is not a day trader, and Trevor, and Jerry, and Andrew. Alex is a new name. Welcome with us, Alex. Lovely to have you with us. Barry's with us, and oh, Justin's with us. Well, you should know, if you don't already, that Justin is the most important Danielcode member, and he's more than a member. For many of you, he's been a teacher. And if you go to the home page of the Danielcode, you'll see there are 4 videos on the front page, the landing page. And if you were to click on videos 2 and 4, you would be listening to Justin, who's been a Danielcode member for a very, very long time, as was his father, Hank, who's a wonderful man. And Justin, I'm delighted to have you here because you've been on my mind lately, because you've racked up now 6 months, excuse me, of your live trading. And I would about to write to you and say, would you update me on your results on a confidential basis? There's no need to be sharing your information any further than you have. That the opus magnifica of video number 4, where you've done over 100 years of back testing of Danielcode time trading, and been so incredibly generous to share it with all of our members. Folks, if you haven't seen that already, I really do urge you to go and see it. It's quite extraordinary. Sean down in Adelaide's just arrived. Hello, mate, lovely to have you with us. That's great. And we have a lot to talk about today, and I should, I guess, issue a warning to those of you who are crypto traders or interested in crypto, that you shouldn't eat too much tonight because it might give you indigestion. And when you see the crypto chart I'm going to show you very shortly, that will give you a large dose of indigestion. And that's because crypto's had a very dramatic pullback. It looks a lot more dramatic than it is, but it's a very, very significant amount of money nonetheless. And what I'm going to tell all of you crypto folks is, if you've lost money in the recent drawdown, you have nobody to blame except yourself. You could have at any time since 2007 asked to have a tutorial with me. And when you do a Danielcode tutorial, either the live one-on-one version with me or the TTT version, the very first thing you'll learn is where the Danielcode comes from, what are the time ratios that the Danielcode creates apart from the rule of 8s, what are the specific DC time ratios, and with your very first lesson, we give you the Danielcode tools, the particular proprietary tools that we use, which are embedded in Trade Navigator. And 2 of those tools, the most basic of them, is the Danielcode time cycles, and at the same time you get a slightly different tool which gives you all of the Danielcode price ratios, which themselves come from the Danielcode time cycles. So you're going to see that, and if you've lost money, as I say, it's only because you were not careful enough to get yourself some tools, in other words, some knowledge to protect yourself in markets. And you're going to see that as we go along. Okay, Justin, can you hear me all right, my friend? down there in the Hunter Valley, the beautiful Hunter Valley. How about everyone else? Can you hear me okay, guys? Please just type in the question box if you would. 1, 2, 3, 1, 2, 3. Anyone? No one. Okay. He's got it. Good on you, Justin. Wonderful. Thank you, mate. All clear. Wonderful. Okay. I have a phobia about all things electronic because I'm a Luddite. In fact, I'm pretty much the chairman of the International Order of Luddites. And a Luddite is someone who, it's that sort of old English during the Industrial Revolution, that term. And Luddites are people who oppose new technology. I'm very much in that category. I have this wonderful gift with anything electronic. If I get too close to it, it stops working. So my relationship with computers is basically, I know where the start button is, and if it doesn't happen, that's it. In fact, it's a bit worse than that. Many years ago, when I was a young man, which is many decades ago now, I realized that computers were going to be a big deal and that they were going to become a part of our everyday life. Not being proactive, but sort of being a reluctant hostage, I went and I bought myself a computer. And I started this thing up, and I was, it's a long time ago, I was living in Bellevue Hill in Sydney at the time. I looked at the computer and the computer looked at me. And that's all that happened. For many months, I looked at the computer and the computer looked at me and nothing happened. And that's because it was the old MS-DOS computer back in those days. And if you didn't know the MS-DOS code, nothing happened. And there wasn't a Google around that you could ask, how do you make this thing work? So I had no further engagement with computers until Windows came out, where Microsoft were kind enough to give you a picture that you could click on, and then something happened. And that's been pretty much my development with not just computers and anything electronic. Either way, it's been a fraught relationship, I should say. Anyway, not so fraught that we have to sit here all day. Let's have a look at what's happening in our tutorial webinar today. So this is a slide at the start of all of my webinars. Markets are rational, orderly, and sometimes predictable. And you're going to see that today. And it's very important in your understanding of markets that you know what the key points and the important turns in markets are going to be. This next slide comes from one I've been showing you, and it says there is no such thing as artificial intelligence. It's just Google on steroids. Who said that? I did. Astonishingly large numbers. It will take 5 trillion to fund the AI cycle. And apparently the US government is on the hook for over 1 trillion. The dollars involved in the build out of AI are absolutely staggering. And the AI narrative is what's been keeping equities roaring ahead at unprecedented levels. So I have shown you that simply because I want to put it on record that I'm very much cynical about AI. I understand the basic stuff it's going to do, but some of the things that are being claimed for it, I think they're all people talking their trades, which is what everyone does, isn't it? So today's themes are going to be some of them you saw last week. The greats don't know. That's an important part of understanding markets, because so many of you go to the so-called gurus and try to learn trading from them, and I can assure you I've been to all of them, regrettably it's just not so. They're not that sharp, and they tend to do what the group does. A whole lot of groupthink going on, which is sad because it prevents them from learning the real probabilities of markets, which is at the Danielcode. rules all markets in all time frames. So this is for you Bitcoin people. As I say, if you lost money in this pullback, which started in October, you got no one to blame but yourself. Because as you can see here, the horizontal range across here runs from the first blue line in November 2021. It brings in the four major ratios that we see all the time in time cycles. The first one is 44, which is the specific cycle for gold, but it acts on all markets in other ways. 59, which is the second number in the Danielcode iteration. 62, which is the alternate to the black line. It's the blue line that comes from the rule of eighths, which is terribly important in trading. Until 55, 56 years ago, markets traded in eighths and sixteenths. All markets did. That's what Gann used, and that's what Jesse Livermore used. They used the rule of eighths, and a half of eighth, of course, is a sixteenth. And that vibration, the 62 blue line, just keeps returning. Markets repeat. The most basic assumption of what markets will do in time is they will repeat. And then they will multiply, and then they will halve. In other words, the Danielcode lexicon of time, times, and a half applies to all markets in all time frames. And what I was interested to show you here, this is actually a Bitcoin chart, and this is the 24-day chart. Every bar on this chart is 24 trading days. Bitcoin's a bit different. It trades for 7 days a week. It trades on weekends as well, as does Ether. That's one of the features of the crypto world. So if you wanted to know when the next significant turn was going to come, you only had to take this tool, and it's just a click on, click off. You click on the icon, and then click on the most recent important high, which was November 2021. It gives you the 44, which didn't do a whole lot, but it has for 3 months now told you that the closing high in October was made at exactly a 59 Danielcode cycle. That's 59 lots of 24 days. And you can see that, or you should know at least, as I've told you many times about time cycles and price cycles, these cycles are valid on the bar high low or on the close, which leads us to the idea that the dominant turn cycles can happen at the chart high, which is the next bar after 59, or the closing high, which is the bar that's exactly sitting on 59. The 59 often alternates with the 62, so they're on the same tool. It'll give you 4 time cycles, 44, 59, 62, and 70, and you can use that tool on any time frame you like. This is a 24-day chart. It'll work exactly the same on 12-day charts, 6-day charts, daily charts, 1-hour charts, 15-minute charts, anything you like. They all work exactly. All markets work exactly the same on the Danielcode. And here we had back in October the closing high sitting right on the 59-day expiration of the 59-day cycle. Well, what did that mean? Well, it meant you were very likely to get some corrective price action, and that's exactly what's happened. And it's not a tremendous retracement. It's simply a correction of the minor swing. It's not even correcting the major swing, which goes all the way back to December 2022. But it had its 59 cycle. It's had 1, 2, 3 bars down. It's gone into its 62-day cycle, and it's bottomed right at the Danielcode retracement, which is 8445, and pretty much exactly. And it's put in what at this stage is a pretty keen key reversal bar. So as I say, if you had done a Danielcode tutorial, either one-on-one with me or the TTT, you would have got this tool. And you would have been aware that this was a very high probability of a significant turn and at least a minor correction, which is what we've got so far. It won't seem like a minor correction if you bought this thing up near the highs. I can assure you, went all the way down to $80,000, and that's a significant dollar drop off from the high. But there it is. It's quite straightforward. It's quite simple. I've shown you this tool on many charts over all the years since the Danielcode website went public in 2007, and at any time, had you wished to inform yourself about markets, you could have called me or sent me an email and said, I'd like to do a tutorial, and I would have been happy to oblige, and you would have had this tool sitting on your chart, and you could have done exactly what I've done, looked at the really obvious place for a correction, 59 cycle from the what was then excuse me, the all-time high in 2021, and you'd be sitting on top of the world saying, I might get a correction here. I've got to start thinking about protecting my very valuable asset. So there, as I say to you, don't eat too much dinner, because by the time you get to see this, if you're into crypto, this will give you a decent dose of indigestion. A very significant amount of money that has been lost by some people, and that could have been you. Alternately, you could have done a Danielcode tutorial, and that would have got you towards being the master of time cycles. And we move now to the S&P, and this is a chart that I posted on the Danielcode website on the 4th of November, and this is a very long-term chart. It actually runs all the way from the 2007 high, and it also has a shorter version that's running from the COVID flash crash in March 2020. For those of you who are regular Danielcode folks, you will know that I've been speaking a lot about the COVID flash crash and my belief that it's now become one of the bulwarks, one of the major strong points, if you like, of the S&P market, of all markets, in fact. But this is one that we show a lot because so many people trade the S&P and what have you. Same thing. You can see that it's valid to start this time cycle either from the bar high or the closing high. In this case, the long-term cycle along the bottom, running from October 2007, the high before the 2007-2009 crash, which was so much fun for us traders, and so bloody awful if you were an investor who didn't know about Danielcode. That one's running from the bar high. You'll see as you move along that the smaller cycle that's running from the COVID flash crash could be where it's starting, which is the swing high, much as I just showed you in Bitcoin, and the very next bar was actually the swing high. So you have a closing high and a swing high. Same way you'll have a closing low and a swing low. They can sometimes be the same bar, but they don't necessarily have to be. And what I wanted to show you by slapping this on the front page of the website was look at all these numbers reinforcing each other. 59, 59, 59, and sitting in the lurch right beside it, 62. And these have vacillated at one bar. And at that stage, they're all shouting at the swing high that was in at that stage, which was the 4th of November. And we had, of course, a Danielcode TO3, and I think also a blue line sell for the S&P right exactly at its high bar, and I posted these charts for you 2, perhaps 3 days later. The high bar was followed by 2 inside bars, so you were right on this, absolutely at the top of the tree. This was the comment that I put with it, that this chart has got so much data on, it's a bit hard to see, so I'll show you a cleaner version of it. And what I've done here is I've actually gone, this is all straight off the front page of the Danielcode post I put in, showing you this 59 cycle here, running also, apart from the COVID flash crash swing high, which is what this one runs to. And you can see that in this particular 24-day chart, the swing high and the swing low come on the same day, or the same bar, I should say, which is 24 trading days in there. And it ran exactly 59 into the high in the S&P on the index. And the index and the futures has diverged noticeably from the index. It was putting its highs before the index. And generally speaking, the index is the most powerful chart on any market you're looking at. And the final comment I put below was hard hats required shortly, meaning things were going to start falling on your head. And we certainly have had a few knocks on the head since that high. This is this is just a blow up, folks, so you can actually see the numbers. It's that same 59 that floored Bitcoin at the high. This is what stopped the S&P at its November high. So it's a terribly, terribly powerful tool. And you can see that these charts have all clustered around either on the bar, which gave us the closing high, or the bar before. And as I've told you many times, these time cycles are valid plus or minus 1 period. So the fact that they're a bar before or after, they're still valid. And the reason for that, why can't they be more accurate? You'd be really a very picky person if you said that, because they're quite amazing. But there are almost a third of all the bars on your charts. You don't see them, they're not there. And those are weekends and US federal holidays. And you've got your 54 weeks, and you've now got your 13, I think it is, federal holidays on top of that. And if you add those up and calculate it, you'll see that that's 29.7% of the total bars on any chart are not there. They're not on the chart. And that should, and no doubt it does, create a systemic error that repeats constantly. But the magic of Danielcode is that it overcomes that. You don't need to run a chart with the gaps in it for the non-trading days. As you can see, all of our stuff comes straight off the trading charts the way they're published. So that's what gave us the high in the equities. So what happened to equities? Well, they took a massive dive, and they ran down $21,000 from the swing highs back on October the 30th. And this, again, we're now into daily bars, make it a bit clearer for you. And that's pretty significant amount of money, because if you take those 1,715 ticks, you'll see that they're a not insignificant part of the market. So this market declined 24.6% into this little low we've had recently, and nobody knew. Why did nobody knew? Well, the leaders of the masters of the universe, as I refer to them, the Goldmans, the Nomura's, Bank of America, the big players, they managed to totally ignore this pullback. until it got down a little bit when all the writing and talk was about panic. And for what was really just in my view so far, not much more than a routine correction, the sentiment of traders was absolutely appalling. Now, this rundown was a pretty tough bit of trading because the whole meter, if you like, of the bulls, the buy the dip folk, was alive and well. And they got some amazing rallies out of this little rundown, which were extraordinary. And what I want you to look at in particular here is the retracement. Well, the low came pretty much at the Danielcode blue line, as you can see there, 6525. You can pick that up, go to the Danielcode website, and you'll see it in members charts. That particular blue line was been on the chart soon after the high was created. Might have even been before that. No, it couldn't have been soon after the high was created. It's been on there quite a while anyway. It's not a new invention. And if you take a moment to look at the rally, you'll see how precisely it's hitting the Danielcode numbers. And it happened that way on the way down the rundown. Extraordinary. We got every turn, we always do. And I hope you got every turn. If you didn't, it's only because you weren't following the Danielcode. And this is what the larger market got. Zero Hedge is a publication that I use a lot, and I love it. And it's pretty much a highly cynical version of what's happening in financial markets, particularly equities and bonds. And it's pretty cynical. All of the guys there are what's called, what are they called? Let me think of it. Can't think of it. Don't get old, folks. You can lose the odd word here and there, but it'll come to me. And it's a particular school of trading thought. And the boss of Zero Hedge, who goes under the pseudonym of Tyler Durden, he's very good at picking up contradictions, false statements, what have you. And they usually give them a hiding. Well, this one's gone through and has been published by them not once but twice. It was published when it came out, and it was held up in the end of week update as one of the must-read articles. And basically, it's Mr. Eric Peters, who's the Chief Investment Officer of One River Asset Management, who are a big deal. And what he wrote is, at some point, we'll learn who is selling and why. So don't forget, this is a guy who's handling the money for many of you. And this was his conversation. Any bodies floating to the surface yet? I asked the team, all of us on an investment call, discussing markets, the relentless selling in crypto. How about the basis? Any sign of funding stress bubbling up? Leverage unwinds, I asked. And for sure, there is speculation of forced selling. But until a Bloomberg headline hits with confirmation that a specific firm has gone belly up or was forced to scramble for a bailout, that's all it is, speculation. That's all it is. This is from a hedge fund manager who claims to be an expert on markets. Not a clue. NFI. You know what the N stands for? No. You know what the I stands for? Idea. The F can be any word you like. And over the years, you will know I've been super critical of hedge funds because I think that they're what they are is they are a system of immaculate design for the sole purpose of transferring massive amounts of money from the investors to the managers. Don't forget, these great geniuses made the top 20 in the world, mind you, not just in the States, in the world, made 8.5% return on investment for financial 2024. From that, you've got to deduct their fees somewhere between 3.5% or north of 4%. not a very good deal, is it? And you're taking all the risk. And here's one of the luminaries saying, this market, I have no idea, nothing's happening. It's just speculation. That's all it is. Speculation, more sellers than buyers, it's someone. And we all know what an outstanding insight. So these guys are always writing to promote themselves. That's their job. But writing an article to highlight how blazingly stupid you are when you not a good idea, Eric. Be a little bit more careful about what you write, and understand that there's much as you guys are no doubt all geniuses. There is another world of markets that not only don't you know about, you've never ever heard of it, and that of course is Danielcode. So I wanted to share that with you. It's in Financial Sense. If you Google the headline, at some point we'll learn who is selling and why. You can read the whole article, and you should. And a couple of days before that, comment from Mr. Peters. You got this from me on the 4th of November before the market opened for that day's trading, and it was to tell you that we'd reached the state where we had a high probability of a correction. And I've shown you the charts that support that. This is just the words that went with it. It was times and a half, the dreaded DC measure of times and a half. And the last day for the 24-day cycle, a proprietary Danielcode measure of time, proprietary like everything else we do, ends on November the 4th, and that is today for us dwellers in the land down under. Well, we were already short, but this post was posted a couple of days after the all-time high in the S&P. And I want to just vary what I'm showing you for a few moments to show you something else that's terribly important. And I've called this the power of the six. The long-term charts that we create at Danielcode are 6-day charts, 12-day charts, and 24-day charts. And what that means is that this is the 6-day chart. Every bar that's in this chart is created from 6 trading days. And then that transfers to the 12-day chart and the 24-day chart. Excuse me, I've been showing you the 24-day chart since the 4th of November, and I've just run through what it was all about here. But have a look at this. We create 6-day charts for our members, and they are run on crude oil, S&P, gold, of course, and US T-bonds. These charts are published twice a week, more often if necessary. And what you're looking at here is the S&P index. And I want to draw your attention to the February movement in February 2020, which was the COVID flash crash, so-called because it was a 24-day pullback, the shortest bear market in history. And I believe that is the new bulwark. I think that is the new standard from which time cycles are running, as well as the fact that we still have time cycles running from the 2007 high and the 2009 low in the S&P. And that's how long these time cycles, once they're established, they repeat again and again and again. And what I've done here, you can see it's got a little bit of pink over it, that pullback in February 2020. That's the COVID flash crash. And that was actually one of 3. If you move back to the left a bit, you'll see there was another significant pullback in February 2018. And there's another one before that, which was, sorry, the second one was October 2018. The first of them was February 2018. And they look like nothing. But they were very significant then at the time. Of course, this market's expanded so much since then in the next 6 years that they look insignificant, but they're not. They're very, very significant. And in fact, what I've done here is I've run the standard 59 Danielcode time cycle from the swing high of the February 2018 bar. Now remember, it's valid to start these time cycles either at the swing high or the closing high, or the swing low or the closing low. This one runs from the swing high. And you can see where it gets to. It runs along, doing not a lot. That's typical of the nature of this thing. And all of a sudden, at 4.5 times the 59 iteration, what do you get? You get November the 4th, right on that blue line. And it looks to my eye a little bit offset, but I can guarantee you that it's going straight into the closing high of that move, which is what we've just been looking at. And as you can see, the correction from that high is like nothing, just a standard pullback. But there was the time cycle sitting there, blinking away savagely, saying, beware, hard hats below. So I call these three disruptions to the normal static line, I call them the three apostles. And of course, I do know that there are 12 apostles, but in this case, only 3 of them have appeared. And they, as I say, including the one in February 2018 that I've just shown you, they are markers for time cycles running from there. And they don't all hit, only some of them hit. The relevant ones hit. And it's quite extraordinary. This is now moved from the first apostle in 2018 February to the second apostle in 2018 October. And you can see here at 4 times the 59 cycle, there's the bar that's gone straight into the closing high. Again, it looks like it's 1 bar early. It's not. It's right on the closing high. Here's the next one. This is the 3rd apostle. In fact, this is the COVID flash crash. And we usually run the time signal for this off the swing high. But in this case, the swing high is a day before the big push down starts. And what I've done here is I've used the closing low. The highs and lows of moves are both valid. This is particularly valid because it was such an extraordinary movement, 24-day bear market that was it all over. What I've done is I've actually run this time cycle from the closing low of the COVID flash crash. Same thing exactly. Have a look where it gets to. 3 times the 59 cycle gives you the closing high in November 2025. So they're the 6-day cycles. They're pretty strong, aren't they? I find them very, very interesting, and I hope you do too. And they might get more interesting as we go along. What I'm going to show you now, these are the standard 6-day charts that we do for clients. Every bar is created of 6 trading days. This is crude oil, which is very interesting because way back a couple of months, we had the low went down. I put an arrow on it and said, this is Danielcode target recognition. The market closed. Remember that these Danielcode time cycles, which then convert into price cycles, remember that they are valid on the high, low, or on the close. Both are valid. This one has elected the close. Excuse me. And it's closed on that 56.92 blue line. What's interesting to me, and I've put an oval, a blue oval around the number so you could be aware of it, is the 57.69, which is the Danielcode black line, very important. That's the 59 price cycle derived from the time cycles. And it has a particular purpose. It does what all the other price retracements do. It provides support and resistance. But the Danielcode black line is famous for another reason. A close below that black line would signify that the low is going to be taken out. And the same going up. If you get a close above the black line, that shifts the odds massively that the swing high will be taken out. And it doesn't mean a whole lot really on daily charts other than as an indication of direction. But when you start putting this on 6-day and 12-day and 24-day charts, it can be massive. At the old highs in gold, we had one of these, I was talking about it at a webinar, some of you may remember, and we had a close above the black line, which moved the odds massively in favor of the swing high being taken out. And that little trade there, just on the basis of the black line, was about $28,000 per one contract. So it's vital information. And I'm interested in this because when the market that's pushed down a couple of months ago stopped and reversed after breaking through the black line, it went to a great deal of trouble to make sure it didn't close below the black line. And it's still doing exactly the same thing. It went through today, this current bar went down to 57 odd, and then it rallied to close above the black line, which is at 57.69. That's the major black line for the big swing. Keep an eye on that. I've left it sitting there for a couple of months now. It's an important support. In fact, for this market, it's vital support. If that gets broken, expect the big swing lows to be taken out fairly shortly. This is S&P futures. This is again the 6-day chart. And you can see all of these charts are all turning at the Danielcode red lines, blue lines, black lines. In other words, they are showing target recognition at these numbers. And that means they've had a high, a low, or a close, as the case might be, within 0.1% of the price target. That's not 1%, it's 1/10 of 1%. That's a very, very small number. It's very hard for markets to do. And what's even more interesting is I calculated that 0.1% variance to make target recognition valid way back in maybe 2010, 2011. And markets since then have got so much bigger, the equities in particular, they're 3 and 4 and 5 times what they were. And even though they're all, of course, still abiding within that 0.1%, the reality is that they're actually marking these numbers much closer. And it's much closer now to 0.05%, less than a half of a tenth, a fifth, less than a half of a tenth is the typical variations. As you can see on this as a 6-day chart, you can see how this market is just ticking off the Danielcode target recognition, either at the bar high low or sometimes on the close, both of which are valid. Have a look at the next chart. This is gold. It had a 13-tick variation at its high. That blue line's been on this chart literally for months and months. That's the benefit of the 6-day charts. And that variance was 13 ticks, which sounds a lot, but it's not, because over 6 days, that's only roughly about 2 ticks variance per day. And that is fabulous target recognition. This is UST bonds, and I want you to note, and it's hard not to note, that it's got tags all over it, saying 2-tick variance, 1-tick variance, 0 variance, 1-tick variance, 0 variance, more 0 variances. In other words, I'm highlighting how incredibly accurate this 6-day chart is. This is UST bonds, one of the most rational markets that we have, and it is just totally besotted with Daniel's code. It just keeps running up and down, finding these numbers with this enormous level of accuracy. And I'm showing you this to point out that while all markets are governed by the Danielcode and they're all abide within the 0.1% variance, some of them do better than others. And this is presently the star of the 6-day charts. But the same thing happens in other markets. Some markets are more accurate. This is the S&P from its recent correction. And you can see it was 1-tick variance from the blue line at the high and 3 ticks variance from the blue line at the low. So this is highly, highly accurate, more accurate than anything else you've ever heard of. And have a look when it starts to rally. You get the first key reversal bar, the big bar up. The next bar, its high is almost exactly on the blue line, which is the 62.5% retracement at 6793. And not only is that the high, but what happens with the close? It rushes back to try and close on the red line, and it's very, very close to it. So you can see how accurate this is. This is the S&P. This is the NASDAQ, and the NASDAQ is the market leader in all of the indices. It's what's causing this great excitement in AI and the narrative that the benefits from AI are huge, inestimable, all to come. And of course, the NASDAQ is also working powerfully. NASDAQ stocks are working powerfully in the S&P as well. Although the Magnificent Seven, as they call them, which is Meta, Microsoft, Alphabet, Tesla, the electric car company, and a couple of others. Those Magnificent Seven, they're in the most of them are in the S&P as well. And in fact, those 7 stocks in the S&P now account for over 42% of the price movement in the S&P. In other words, that small handful of NASDAQ type stocks is running not only the NASDAQ, but the S&P as well. That 7 is 42% of the total S&P market. Extraordinary, isn't it? So here's the NASDAQ, and this is daily bars now. October the 30th, we had a nice TO3 and a blue line sell signal right at the high, and we had a blue line across there to show target recognition. Now, this is what's happened. As it started to move away, you see from the high we had 2 inside bars, then a biggish bar down. Look where it closed, very close to the first red line. Then we had the next bar that ran down and did a key reversal bar back up. Where did it close? Exactly on the next red line. What happens to the bar after that? It looks like it slipped through a bit, doesn't it? It didn't actually, as you'll see, but looked a bit like it there. And then finally, the bar that marked the first low after the high, it roared down, hit the red line at 24,738, minus a few ticks, and did a key reverse. We didn't get a key reverse bar, it didn't go high enough, but it gave you a reversal bar anyway, which caused the mad cap rally the next day. And as we look further across, we can see on its next iteration going down, it found support at 2440. But that's only the first retracement that we're looking at. In fact, there are 3 retracements here that are going to take the control of this market. So this was the first rally from the first push down, and essentially you had 2 major targets, the red line at 25,700 and the blue line, the 62.5 at 25,765, I think it is. And you can see the highs were exactly at the blue line, and the close was exactly on the red line. And the next day it opened exactly on the red line, ran up to the blue line, did a reversal, said ta-da, and that was a key reversal bar. The very next bar opened a bit nowhere, ran up to the blue line, got its hand slapped, did another key reversal bar. So no surprise, the market goes down for a few more days. Let's move on. This is what happens, you can see, as this market moves down, and it's only talking about correcting the first retracement. It's got the number 1 under it. That's the first major retracement before the October 30th swing high. And you can see 1, 2, 3, black diamonds telling you that that was almost perfect target recognition. Is this a strange thing? No, markets do this all the time. Here's what happens after that. We had a little rally. Where did the rally go to? Almost exactly to the upside blue line retracement. There it was. The low wasn't in there. That we ran from 2 bars before. This madcap rally up. This was a huge move. That bar on its own was $11,400 in range. Can you believe that in the S&P? In the S&P, super duper. It closed almost on the blue line at 25, and that's the interim term. 25,000 plus a few points, not many. Did a key, very strong key reversal bar there and dived down. That's the bar that was 11,000 plus dollars in range. So what happens after that? We saw the rally hit exactly on the blue line. That's what turned it at the high, if you didn't know. And now we can start to look at the other retracements. We've dealt with retracement number 1. It's got a number on it. The second prior retracement has got a number 2 on it. It's almost exactly the same as the low bar, 1, 2, 3, 4, 5, maybe 10 or 11, 12 bars before, after it, I should say. They're very much the same. I've only used one of them. It's splitting hairs otherwise. And the final retracement before that high, the low before that high, has got the number 300. And they are all valid retracement targets. So you can use your same Danielcode tool, which is the Danielcode retracement tool, for each of those retracements. And look what happens. Look at these black diamonds. Target recognition, target recognition, target recognition, all the way, all the way. And the red line at 74% of the swing down to number 3, that was the biggest swing from the high, that nailed the low. The bar before would have to be sitting on the prior 74%. The next bar dived down to the bigger 74%. Key reversal bar, off it goes, roaring up like a mad dog. So there we are. That's what happens. Rally, rally, rally. And that's what we're looking at now in the NASDAQ. And there's been some enormous buying from that low. So have a look at this chart. What we've done here is we've, I think, got past the first major resistance. The first, there's 3 black lines should be on here. But the big one at the top, 26,000, that's the absolutely dominant one. And the one before that, oh, you can see it here. It's the subterfuge under the blue line at 25,385, which has stopped the rally so far. So if you'd like to learn this stuff, folks, and make sure you never lose your money trading futures, Forex, or crypto, you should do a Danielcode tutorial. This is our short video version. It's been very, very popular. It's also a fraction of the cost of the full videos, the full tutorials, which are all one-on-one with me personally, which of course that would give you the very best education, but it is expensive and time consuming. And the Teach Yourself to Trade, the TTT video series, been very, very popular because you can do it at your own time, at home, anytime you like. And once you have the videos, they're yours forever. You can just go over them and refresh your understanding of markets, which is the basis of everything we do. What I talk to you about starts off by really understanding what makes markets move and where they're going to go to. And we can't tell you exactly which one's going to turn, but we can say with a high degree of confidence that it can only turn at the Danielcode numbers. And to support that statement, you could go to the website and click on the link that says Chart Archives. And what you'll see there is over 45,000 Danielcode charts, all of which I've created manually since the website went public in late 2007. And you will be hard pressed to find a market that has ever turned anywhere except at its Danielcode numbers. So that's there for you, folks. So I wanted to just hurry along a bit and show you some of our Forex trading for the week. Interesting. Here's the Aussie rallying very strongly against the US dollar. Nice buy there, got a decent little push of money out of it. This is the New Zealand US dollar, same thing. It's showing New Zealand strength against dollar weakness now. Those of you who understand this part of the world, New Zealand's pretty much a basket case financially after Jacinta's tricks. And Australia's heading the same way with this appalling Labor government that we have. We've got from it exactly what we always get from Labor: spend, 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 tax, tax, tax. It's happening in the UK. It's happened here in Australia before. It's now happening again. And because there are so many young people coming up and becoming voters as they mature a little bit on age, they don't have a memory of what Labor will do. And what Labor does is what Labor always does. It never changes. The faces change, the policies never change. And it's worth go and have a look at the Guardian newspaper, which is a very left-wing socialist newspaper, beloved by all the socialists in Britain, but even it will tell you the latest budget from the Labor government in UK. Taxes are going up to all-time highs. What a surprise. And there's a whacking great 40, 50 billion, trillion, depending on who you listen to, black hole in the UK's, Britain's financial accounts. Tax, 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 and spend, spend, spend. Tax the rich, give to the poor. These days, the rich is anyone who's got a job because so many people don't in Britain. It's terrible. Absolutely terrible what's happened in that country, it makes my blood boil simply because of the stupidity. You know what these people are going to do. It's like the scorpion and the frog. The scorpion's nature is never going to change. It's going to get a lift across the creek and it's going to sting the frog and kill it. Why? Because it's a scorpion, and that's what happens with Labor. It ruins economies. Why? Because it's Labor. And this is the other one. This is showing weakness in the US dollar and strength for the Canadian dollar, which is called the loonie. And the US has been on a big bashing of Canada lately, and that's why you can see the significant upthrust that's been going on in this market for a long time. And this is the first time. This is a really big momentum bar down, and you don't see many of those in this market because it's all been the other way. All the big bars are roaring up, and this is a significant change. These three charts I've showed you, they're all correlated. You could have traded one or the other. Don't trade them all together because they're correlated. You're seeing the same essential movement. This one looks like it's going down, the others were going up. It's just the way they've organized the naming. If they call this CAD USD, it would have gone up as well like the other two. But that's a significant change in the Forex market. And it's something well worth keeping in mind for you guys who are interested in Forex. Here's a couple of little markets we haven't talked about. They've done exactly the same. We got long the Russell first day up, and it's been $5,000 per one contract. And if you look at it, it's actually rallied a bit harder than the other markets we've looked at. It's significantly taken out one and possibly two important rally points. But as always, all markets are ruled by the Danielcode. Where did the current rally stop at? 2507. Why there? Well, that's the Danielcode blue line. You can go to your members charts at the Danielcode website. They're updated twice a week, sometimes more often. If we get really big bars, I will update them every day if necessary. And put these numbers on your charts and see what happens. That's all you've got to do. You will soon learn that this stuff is, as far as I know, pretty much infallible. This was the NASDAQ. You can see how its correction, much bigger money, it's a much bigger contract, but it hasn't corrected the two higher levels you can see, okay? It's fairly weak so far, the correction. Interesting stuff, but it leaves the option open. This has not been a great trading market going down. In fact, it's been a bit of a so-and-so because the bulls keep buying those dips, roaring a markets up. It has been hard to trade. Very, very good for the day traders, let me tell you, because the day trades, they've all turned exactly at these Danielcode numbers. If you do nothing else but go to members charts, take the red and blue numbers and put them on your chart, on your daily chart, then switch to the chart. So it's a 15-minute chart, 5-minute chart, 29 minutes if you're clever, 59 if you're even more clever. You'll see that all these intraday markets are turning pretty much exactly at these Danielcode ratios, both up and down. That one thing will change your intraday trading forever. And if you want to understand more, let me know. I'll teach it to you. Okay, you can see it in the syllabus I've sent you if you want to learn it in the TTT version, which is very much cheaper. That's why we bought it out. So there was a trade there, and this is the S&P. Again, relative to the NASDAQ, this is a bit stronger rally, isn't it? Where's it stopped? Blue line, 6846.25. Can't change it, happens all the time. That was a really simple TO3 buy signal from the day before. So we're about up with time, folks, and thank you so much for being with me. You've stayed with me the whole time, for which I thank you. Rolf, welcome. You came late, but it's terrific to have you here, my friend. Rolf from down in Melbourne, and that's wonderful stuff. Thank you, all of you who turned up today. Do enjoy your weekend. Do take a free trial of Danielcode if you haven't already. Finally, I always show you our disclaimer, which basically says, please don't waste time and money trying to trade if you don't know what you're doing. It is very, very easy to lose a lot of money trading derivatives, of which futures and Forex are the most prominent. It is very easy to lose a lot of money if you don't know what you're doing. The good news is, if you do know what you're doing, in other words, if you've taken a Danielcode course or two, it's very easy to make a lot of money pretty quickly and nicely. So that's it, folks. Thank you again for being with me. Justin, of course, thank you, my friend, in particular, and the rest of you. Enjoy your weekend, and I'll look forward to seeing you next time we have a webinar. So it's bye-bye for now.